session. I think that will be comfortable with you, Anand bhai. Right.
Yeah.
Once we complete the presentation, after that we will open this session for question answers, and the members, they can raise their hands, and we will be unmuting them so that they can one-to-one ask the questions to our members. Right?
Yes, whatever works. You can unmute, or even the Q&A tab. Feel free to put your questions, and
definitely
try and answer most of them. So yes, pleasure to be once again at the Villeparle CP Study Circle. Predominantly two reasons why it's a pleasure for me. One, it happens to be my so-called home study circle, because staying in Villeparle, naturally associated with this particular study circle. And secondly, also a lot of friends, professional colleagues, seniors in the profession who are there in this study circle, kind of make it much more at home when it's always at the Villeparle study circle. There's also a third reason, perhaps, which is missing this time, is the fantastic and the delicious snacks that are always arranged at be it the samosa pav or the masala chai that is typically there before the session. Yes, we all miss that, but 77 of us are here without those masala chai and snacks, so it's encouraging in that sense. So also, the topic today, friends, as selected by the organizers, is slightly offbeat in terms of talking about related party transactions. It's not the bread and butter topic of tax or accounting per se, but we'll focus more on the interplay across these domains of accounting, tax, law, and how the related party regime has evolved, and what are the key compliances and what are the key aspects that an auditor should be aware of, particularly when we are dealing with our clients. Friends, most of us would appreciate that the related party as a concept, has been in spotlight since last maybe 5 to 6 years, since the Companies Act 2013 came into play. Under the old Companies Act, we didn't quite have any kind of reference to related party transaction, but for some provisions around section 297 or 294, which dealt with some aspects. But from a corporate law perspective, it was the Companies Act 2013, which was really the watershed moment for related party transaction and their governance in India. Earlier, we always had our AS 18, or the Accounting Standard 18, that dealt with related party transaction, but it was restricted to a disclosure. It was a standard that required companies to disclose certain related party transaction, but it was never a all-encompassing kind of a solution as a standard or as an accounting guidance. But Companies Act 2013 and then the SEBI changes that happened after that has really changed the way in which we look at related party regime in India. To my mind, related party transactions, as they are there across these various statutes, are more anti-abuse in nature. Because per se, related party transactions are not bad. Related party transactions are in fact there in every commercial transaction. It also helps an entity if I am dealing with someone whom I have comfort on, or someone whom I am related to. So there are strengths inherently in related party transaction which a business can leverage. But there is a risk of conflict as well when we are talking about related party transaction. So across this session today, you would see there is a fine balance act amongst these regulations between enabling commerce, so that related party transactions can actually help commerce, and avoiding situations of conflict, which is the pain point when it comes to related party transaction. And earlier speaking, we didn't have that related party regime, so everything was okay. Now we have gone on the other side of the pendulum, where there is to some extent an over-regulation on related party transaction. But yes, balance is somewhere in between. And as a country or as a regime, we are still figuring out what should be the right balance in terms of related party regime. Friends, there are some nuances which are very typical to India. And understanding those is important prerequisite before we can understand the evolution of the related party regime. Some important pointers to keep in mind is that India per se is an entrepreneurial society. Most of us, would want to have that flexibility to do something on our own. In Gujarati, there is a kehvat ke nanu pan potanu. Given a choice between working for someone and working for myself, many of us in these entrepreneur communities and societies would want to work for ourselves. One of the very reasons why some of us would have done CA would also be because it offers flexibility of being in employment, but also allows me the optionality of getting into and doing on my own in terms of my practice. So India is an entrepreneurial society, and the fact that we have 6.5 crore MSMEs today in India is one indicator of so many businesses and business-driven community that we are today. Friends, India has the highest number of companies that is registered under a single act, that is Companies Act 2013. There are about 11 lakh odd companies, and that's the highest ever number of companies in any country across the world. It's important to note that India also has the highest number of listed companies in the world. The Bombay Stock Exchange has about 5,000 odd listed companies, which is the highest anywhere in the world. The nearest perhaps is the Chinese Stock Exchange, or maybe the NYSE plus Nasdaq put together, but standalone it is the Bombay Stock Exchange. So when we are talking about smaller businesses, at the same time quite a few publicly interested in terms of listed entities, that is where this whole needle of conflict is very important from an Indian perspective. India also has this very unique animal which is known as a promoter. You don't see the concept of promoter too much in some of the other regulated or other developed jurisdictions, but India has this unique element of promoter which has under the Companies Act 2013 also defined. And look, if you take a step back from a governance perspective, in a company you have shareholders, which are the owners. After shareholders, you have the board, which is governance, and then you have the management, which actually runs the show. So owners are not involved in governance, and governance is not involved in management. But when we see and talk about many of the Indian companies, you would see that there is this one element or animal known as a promoter, who is an equity shareholder, a large equity shareholder. He also sits on the board of the company and may also be a CEO or MD of a particular company. So the three control or check and balances of a shareholder, board, and a management, this promoter cuts through those and again gives rise to conflict. I was going through the BSE 500 companies and how much on an average promoters own in BSE 500 company. And roughly 49% of average shareholding in a BSE company is owned by promoters, and it's only 9% of promoters have stake below 25%. So we are looking at a large number of listed companies and also a large shareholding controlled by the promoters, which is not the case in some of these developed jurisdictions where it is more professionally managed companies or not having so much of promoters oversight or overhang into the management of the companies. And another typical part in India is also the concept of a conglomerate. Now, if you see, let's say the Tata Group, right from pin to planes, is something that they would have their engagements in, or many of the other conglomerates or groups that have evolved would have multiple different businesses. Typically, internationally, large companies have been focusing on one segment and not spreading across segments, unlike few others, let's say like 3M or Honeywell or others. But by and large, India has this concept where we have conglomerates managed by a group of people, which also gives rise to situations of conflict. So the solution that we need to have in India for a related party regime is much different and should be much different. And we just can't copy paste it from what was there under let's say the Companies Act 1956 came from the English law, or the SEBI regulations came from the SOX predominantly, but related party didn't have any precedence across these developed countries. So we in India have evolved this particular regime depending on what we have learned, depending on some of the abuse of related party transactions that happened and problems that shareholders faced in conflict situations. So to give a high level perspective, we have the whole regime of tax laws led by the Income Tax Act, the GST, and the custom provisions as well, which deal with related party. As far as income tax is concerned, there are certain provisions which are beneficial to related parties. For example, gift to a related party. Section 56 defines who are those relations, and I can gift to that related party without attracting tax or capital gain in that sense. And there are some provisions under the Income Tax Act which are anti-abuse. For example, transfer pricing. When I'm dealing with two related parties, I need to make sure it is at arm's length and proper checks and balance are built into the way in which I'm dealing with that associated enterprises. Similarly is the case with GST and customs. And when we come to the accounting, corporate, and the commercial laws, we have the AS 18, which is the old accounting standard 18, and we have the Ind AS 24, which is an adoption from IFRS. These two are predominantly from a disclosure perspective. In the annual report, there are certain disclosures which are required. Those are governed by the accounting standards. We of course have the Companies Act, Section 188, which predominantly deals with the related party. SEBI for listed companies has provisions governing RPT in the LODR. The recently enacted Insolvency and Bankruptcy Code also has elements of related party regime in India. In relation to takeover code and insider trading, we have a different regime of related party. And when it comes to Competition Commission, there's a different regime of related party. So each of these statutes are trying to plug a particular abuse or are trying to give a particular flexibility. And depending on what is their objective and intention, they have defined who should be related parties, and they have defined what transactions are covered by related parties. None of these acts have a consistent definition, nor they have a consistent transaction coverage that would fall within that regime. And that is where it gets into a zone of complexity, where you have different regulations, different definitions, and different coverage that give rise to different compliances. Friends, this doing business in India ranking is talked about a lot, right? That the Modi government as well, we have a target to be in top 50 economies in this year itself. Current rank that India has is 63 across all about 215 countries that this ranking tracks. Within this overall ranking, there are about 6 compartments, and the 63 is a cumulative ranking of those 6 compartments. One of those compartments is protecting minority investors, and what are the rules and regulations in India for protecting minority investors. And India ranks 13 in that, which is much better than all of the other 5 provisions which are there. Now, related party regime falls under this protecting minority investors category. If you further dissect protecting minority interest, there is an attribute of shareholder related index, that a particular country has so much of beneficial laws for minority shareholders. That is where India is actually ranked number 1. It's a joint first with a few other countries, but the kind of related party regulations that we have today are, kind of numero uno, or first one in terms of various other countries that we are looking at. So the whole jump that we have seen in our rankings from 110-ish to 63, a large credit of that is on account of Companies Act 2013, the other changes that SEBI brought upon it. And because of this related party provision, it has enhanced protecting minority investors, and hence improved our overall ranking. Yes, we have had GST, yes, we have had IBC and some of the other changes as well. But those reforms have not yet translated into improving our overall rankings. It's a question in front of all of us whether GST has improved ease of doing business or otherwise. IBC has served its purpose or not. But related party as a provision is something that has actually translated into something that is a tangible benefit in terms of the rankings. So how does one go about with identifying the related party regime in India? And to my mind, there are three pit stops that one needs to pass in terms of understanding the regime. The first is starting with who are the relationships. As we said, every statute has a different category of relationship that it covers. So we should first start with who or which are the relationships that are governed by a particular statute. The second question to be asked is that whether the transaction that I'm going to enter into is covered within that particular statute or not. For example, the Companies Act has only 6 transactions which are covered under Section 188. Now, if you are doing a transaction which is not covered under those 6 transactions, you don't have to do compliance of Section 188. But on the other side, accounting standards have an elaborate definition. So a particular transaction may require disclosure in the accounting standards, but not be attracted under Section 188 of the Companies Act. So after identifying relationships, we would need to go into identifying a particular transaction, and post that we will have to map the compliances, because particular transactions have different compliances. For example, if it's a material transaction, which is, let's say, more than 10% of a consolidated revenue of a listed company, there is a requirement to go for a shareholders resolution. But if it is less than 10%, even a board can pass that resolution for related party. Or transactions that are at arm's length have to be treated differently, and transactions not at arm's length have to be treated differently. And we will go through these compliances broadly across these acts. But the important point which I wanted to drive home here is that start with relationships, then going through the transactions, and then mapping what compliances are there in these related party transactions. So starting with the identifying of relationships, a question comes is that, is there a generic or an all-encompassing definition as to who are related parties? The nearest that one can get is maybe a definition under AS 18, which kind of suggests that two parties are considered as relative if at any time during the reporting period. So it could happen that that party is not your related party at the end of the year, but during the beginning of the year, it may be your related party. And if you have the ability to control the other party or exercise significant influence, then it is a related party. Mind you, the words are has the ability. It's not actual exercise or actual participation into financial or operating decisions, but the fact that you have an ability is good enough to prove that you are a related party. At the same time, if in contrast you look at the Income Tax Act, the closest that we can get is in 92A in the definition of associated enterprises, where essentially the definition is not on ability, but actual participation in the management, control, or capital. So while AS 18 is going on control and significant influence, income tax is slightly broader, also going into management or just plain vanilla participation in the capital of another enterprise. Because the purpose is different from an income tax perspective, it is slightly wider in nature, and AS 18 is slightly specific in terms of its dealing. We do not have any principle-based definition under Companies Act, under IBC, under Ind AS 24, nor under the SEBI LODR. What they have is a specific listing of relationships that are called related parties, but they don't have a principle-based definition like what is there under AS 18 or under Income Tax Act 1961. So even if a particular relationship is not covered under the listing, the fact that there is a principle-based definition under Income Tax Act and AS 18, the scope is wider in that sense as compared to the 4 other which have very specific definitions. So to start with identifying relationships, there is a definition of relative. Now, relative is used in the definition of related parties because related parties are your directors, it could be your promoters, and also relatives of your directors and relatives of your promoters. So the definition of relative becomes important before you get into the definition of related parties. So AS 18 defines it in a particular manner, and it also has a catch-all kind of a flavor here, where it is saying expected to influence or be influenced by that individual in his dealings. So a spouse per se may not fall if you can justify that there is no such influence that can be exercised, is what is the flavor that is coming out. If you see Ind AS 24 on the other side, it refers to family members who may be expected to influence again, but it's an including definition. And being an international flavor, apart from spouse, it is also including some of the other live-in relationships of a domestic partner, etc., that may be treated as a relative as far as Ind AS 24. Friends, in this presentation, I have tried to put the actual text as well of some of these definitions, because there's a bit of a reference value that one can keep it and refer it later. But what we'll do is talk about some of these very specific nuances rather than going through the actual definition, because this is all available for all of us to read later. But some key differences is something that we'll talk about across these technical slides. The income tax on the other side has a definition which says under 241, which covers husband, wife, brother, sister, and it goes on the lineal ascendant and descendant criteria. We don't have that in the accounting standards, but it comes under the income tax. There is a specific definition for 56.2, which is the provisions of other income and gift, where there are some additional relations which are also being mentioned. And if you fall within those additional relations, then as far as 56.2 is concerned, you will have the benefit of these additional listing of relatives, which is there as well. Insolvency and Bankruptcy Code. Friends, the Insolvency and Bankruptcy Code has important relevance in related party regime, because what is happening is that if a company is getting insolvent and it is under the Insolvency and Bankruptcy Code, typically there is a question whether related parties of that so-called corporate debtor can again bid for that company in insolvency or not. We saw this going right up to the Supreme Court in the case of SR Steel, where the family wanted to again bid for their asset, and there was a amendment which came under section 29A, which disqualified certain related parties from bidding back for their company, because there was a sense that someone can shortchange the lenders by getting into insolvency, again bidding for the company and making merry at the cost of the lenders. So as an anti-abuse provision, they brought in section 29A and this definition of relatives. So if you see the definition over here, it's so extensive that it also goes into, let's say, mothers, brother and sister, or sisters, son and daughter. So they are thinking through that people should not, as a reverse way or as a side way, backdoor entry into the company through some of these relationships which you can influence. Now, that anti-abuse provision is very elaborate under IBC. There is another provision under which this definition is used, which is fraudulent transactions. So if as a part of the Insolvency and Bankruptcy Code, the resolution professional identifies that some of the happenings prior to insolvency are not at arm's length, or transactions have been concluded in a preferential manner or in a fraudulent manner, then the erstwhile promoters are personally responsible for making good that money to the corporate debtor. Now, if you are a related party and transactions have happened between the corporate debtor and a related party, it is deemed to be preferential unless you can justify otherwise. So the burden of proof, if it is a related party transaction that you have done, let's say within 2 years before getting into insolvency, then the burden of proof shifts actually on the erstwhile promoters to prove that this is not a fraudulent or a preferential transaction. So the requirement of related party under IBC is from a different perspective, and hence you will see a significantly large definition that we have for relatives as well. Under the Companies Act, it's a fairly small definition of about 9 relations. The 1956 Act had slightly more number of relationships that were there, but Companies Act is very clean. One nuance here is that stepmother, father, brother, and sister is also included, and members of HUF are also something that are a part of Companies Act. Friends, it can very easily happen that a particular relationship is a related party as per Companies Act, but is not a related party as per accounting standards, or is a related party as per Companies Act, but not as per SEBI regulations. And you may have different outcome. You may have to disclose that into the accounts, but you may not have a shareholders resolution for that particular party transaction. So all of those combinations are possible because you have different definitions and different transactions. SEBI LODR doesn't define relatives, but it piggybacks on the Companies Act definition and says that I am happy with whatever is defined under the Companies Act, and no need to change the definition. Slight sensibility here in terms of not having one more definition of relative throughout these different definitions that we have. So once you identify who are the relatives, then you get into the requirement of related parties. Every company is required to maintain a register under the Companies Act section 189, in which transactions or contracts entered with related parties are to be mentioned. SEBI requires listed companies to also have a list of related parties, irrespective of transactions or not. And as an auditor, or when we are evaluating compliance with the accounting standards, we may want to obtain that list from the management. If it is a listed company, then you'll have a list of related parties. If it is an unlisted company, then certainly transactions with related parties are something that we can get from the management. And then you can decipher whether compliances have happened or not. So AS 18 is then a very specific definition of 5 relations that get covered as related party, and it is predominantly resting on control and influence and key management personnel and their relatives. Now for relatives, we need to see the definition of relative as per AS 18. It kind of excludes certain relationship just because 2 companies have a common director, or just because I have a significant customer relationship with that entity, it doesn't become my related party. Like many of us would recollect that in 92A and 92B of Income Tax Act, from associated enterprise definition perspective, if I have a business dealing that is very significant in terms of giving a loan or my supply or expenses with that particular party, irrespective of ownership, it would become my associated enterprises. AS 18 says no. You should fall under these 5 categories for it to be considered as a related party. And just because you are under that exclusions doesn't mean that by default you become a related party. The definition of key management personnel also is different when we talk about AS 18, when we talk about Ind AS, and when we talk about Companies Act. So AS 18 is a plain vanilla definition of KMP, which are people who are in planning, direction, and controlling of a reporting enterprise. If you go to Ind AS 24, the definition gets bigger. It's not a specific definition of just those 5 type of relations, but it is a kind of inclusive definition that stretches to about 8 relations and is also inclusive in that sense. Some of the nuances here are that they go to the group concept, that even if it is a parent subsidiary or fellow subsidiary, it will be a related party. Similarly, the definition of KMP is different under Ind AS. Question comes, or a nuance comes here, friends, is that if you read the definition of KMP under Ind AS, there is an inclusion that any director, whether executive or otherwise, will also be deemed to be a key management personnel. Now, when you mention the word executive or otherwise, whether independent directors who are there on the board of the company, whether they become key management personnel just by virtue of being independent directors, or for that matter, even non-executive directors. So, which is where when Ind AS first came in, you had almost all companies even considering independent directors as key management personnel and disclosing transactions with independent directors also in the annual report. But more and more we are seeing that companies have started taking more purposive view that the first test, that you should be having the authority of planning, that should be met, and only then I should consider irrespective of my designation. But the primary test should be met. So more and more companies are now not having independent directors as a KMP, and also independent directors wouldn't want that they become key management personnel of a particular company. The recent example was, when there was this introduction of woman director on the board of listed companies, and in Reliance, you had Neeta Ambani, who stepped in as fulfilling that criteria of a woman directorship. And in the Reliance disclosure, we don't have Neeta Ambani as a key management personnel. So more and more we are seeing similarly in the case of few other companies as well, where independent directors and even non-executive directors are kind of not considered as a key management personnel. Companies Act, again, a very specific definition of 9 relations that are covered as related party, and it is not a catch-all definition, but there are some words that are giving rise to a catch-all. For example, is accustomed to act. Now it is a very generic definition, who is accustomed to act and who is not accustomed to act. But if you are a person and you are acting on someone's direction and you are accustomed to act, then you fall under this catch-all 6 and 7 of this 276, which is the section under the Companies Act. Similarly, the definition of KMP is different than what we saw earlier. Here we have a very specific definition which doesn't include your non-executive directors nor your independent directors. Essentially, it is the KMP as defined under the Companies Act, but it also includes company secretary and CFO in that sense. SEBI is very simple. SEBI says that for me, related parties are both. One, either if you are covered under the Companies Act 2013, or you are getting covered under applicable accounting standards, then you are a related party for me. There was about 3 years before a Kotak committee that was established to suggest certain changes in the corporate governance framework. And the committee suggested that this is good, but SEBI has a concept of promoter and promoter group. And they added one addition to the definition of related party, that if you are a member belonging to the promoter group, and if that shareholder is owning more than 20%, then you are by default a related party. So belonging to the promoter group and holding 20% also makes you a related party, irrespective of the other criteria under Companies Act or accounting standards. Now, these regulations are evolving. In January 2020, SEBI set up one more committee, to further improvise on related party. Because in the last year, there have been quite a few blow-ups in terms of related party transactions, be it from the perspective of Indigo or Raymond, or Infosys had to do a settlement order with SEBI in one of the related party matters. So effectively, there was a committee which was set up under the guidance of Mr. Srinivasan, who is the CEO of Kotak Bank, and just to further highlight what changes are to be done to the related party regime. What they have recommended in January 2020, it is not yet a law, is that remove the and. Even if it is a part of promoter group and holding more than 20%, don't have two criterias, and reduce the 20% to 10%. So the suggestion is that if at all any shareholder who owns more than 10% in a listed company should be a deemed related party. This is not yet promulgated into something actionable, but as it stands today, if you are a promoter and promoter group and holding more than 20%, you are a related party for that particular company. Income tax, yes, a completely different definition of who are related parties. We spoke that income tax is more of a pro-revenue, anti-abuse transfer pricing provision. And here you would see that irrespective of shareholding, irrespective of control, the fact that, let's say you have a loan advanced to a particular entity, more than 51% of the book value, then by default, because of the dependency that you have on that entity or that entity has on you, it becomes the associated enterprise. Similarly, if you have given guarantees or if 90% of raw materials are purchased, then also it would become your associated enterprise or related party. So this is perhaps the most vast definition in that sense, which covers and goes more on the business test as well, and just not on the ownership and the control test. Insolvency and Bankruptcy Code. It defines related parties differently. It is by and large similar to what is there under the Companies Act, but you have this one trustee of a trust in which the beneficiary of trust comes in as a specific pointer. Now, in one of these cases of SR Steel, there was this question whether a trust or a trustee is a related party or not. And there was a concern relating to beneficiaries, again, buying back the company. And this was a specific addition that came into a trustee of a trust. Similarly, being a slightly newer regulation, they have also covered LLPs and firms in that sense. But by and large, linking to the Companies Act definition on accustomed to act with the learnings that they had in terms of the trust structure as well. So we finished the related party identification part. And then we go on transactions. And only certain transactions will be governed by the compliances. So AS 18 says transactions which amount to transfer of resources are something that are transactions. And then it gives an illustrative list. So to decipher whether a particular transaction is a transfer of resource or not is something that is left to a principle-based definition, and it's not a rule-based definition. Let's think through what can be a transfer of resources. If a company declares dividend to its shareholders, that dividend will also be paid to the promoters who are related parties. Does that require a disclosure in my financial statements annual report that dividend is declared by the company? Or if at all there is a rights issue that is done by the company, and that rights issue is subscribed to by the promoters as well in proportion of their shareholding, does it become a related party transaction? Or if it is a buyback in which promoters participate or related parties participate, does it become a transfer of resources? If you read by this definition, the answer is yes. In fact, equity contributions is specifically covered, but I have not seen many companies disclose dividend as a related party transaction. The Ind AS definition specifically includes equity contribution, same definition of transfer of resources, and also includes certain contracts which are to be executed in future. So it may happen that the contract is today not valid, but I have undertaken to perform this in future, then that becomes the executory contract. And even that is something that is covered under the Ind AS definition of transactions. We spoke about the SEBI committee, which was set up in January 2020. They have recommended that please, from the scope of related party, remove transactions like buyback, rights issue, and things which are across all shareholders and not specific to a particular related party. By suggesting that, it is giving an impression that these transactions are covered, and hence they are wanting to carve that out from that definition. Income Tax Act, yes, 92B gives a long list of transactions which are covered. It is not a transfer of resources definition, but it's a broad definition to say having a bearing on profits, income, losses, or assets. For some reason, liabilities is not there in that attributes, but if at all it's a transaction having bearing on any of these four attributes, then it becomes a associated enterprise transaction or an international transaction. And then it is an inclusive list of relationship or transactions. Important feature over here is business restructuring and reorganization. In the accounting standard transaction definition, we don't have any merger, business restructuring, or reorganizations coming in. But under income tax, it's a broadish definition, even to include, let's say, outbound merger or an inbound merger would also be regarded as a business restructuring, thereby requiring the rigors of the arm's length and transfer pricing documentation. Companies Act, related party transaction are only these specific 7 items. So Companies Act was the first one to introduce certain approval process, and they covered rightfully only a limited set of transactions which are important from a company's perspective. SEBI has built upon that to say that irrespective of these 7 transactions or not, any related party transaction which is material in nature, you need to take certain checks and balances. But only if your transaction falls within the 7 requirements are you required to do compliances of section 188. For example, if it is issuance of shares or a dividend or let's say any kind of supply, then only if it falls within the definition A, supply of any goods or material, then that is where you need to cover it under section 188. SEBI LODR says that it can be a transaction, again on the transfer of resources, and it clarifies to say that to include in a single transaction or a group of transaction. So every regulator is adding his bit of 2 cents into the definition and making it different and to an extent justifying its existence. So this definition builds on the accounting standard definition and also clarifies that even if it is a group of transaction, it gets covered under the SEBI LODR transaction definition. So first we get into the relationships, then we identify whether the transaction at hand with that related party falls under the definition of transaction. If yes, then you have different compliances that come depending on the transaction. The most easiest or sort of the most lowest in that particular scale is disclosure. And most of the accounting standards would say that you disclose it in your annual report. SEBI says that for listed companies, there has to be a half-year stock exchange disclosure. SEBI also says that there has to be on the website of listed company a related party transaction listing, and also in the board report, Companies Act requires disclosures. Typically, what we see is that what you have disclosed in the annual report as related parties will not match with what is disclosed in the website or in the half-yearly stock exchange disclosure, which will also not match with the board report, because board report is taking into consideration Companies Act relations and Companies Act transaction. Annual report is taking into consideration accounting standard relationship and accounting standard transaction. SEBI LODR is considering SEBI LODR transaction and SEBI LODR relationship. So you will see most of the companies, what they disclose in the board report and what they disclose in their notes to accounts never matches. If disclosure is not enough, and if it is a transaction that is slightly more material or slightly more serious in nature, then you need to take approval of those charged with governance, which is the audit committee or the board. Now, whether it goes to the audit committee or whether it goes to a board is linked to the quantum, the size of that particular transaction, or whether it is in the course of ordinary course of business and whether it is at arm's length or not. There is a separate flow chart that I have prepared, which will explain this entire waterfall of what goes to an audit committee, what goes to a board, and what goes to a member. But from this slide's perspective, I think the point is that depending on the quantum and depending on the attributes, you may have a differing approval that we may have to take. Sometimes you may also need to take shareholders' approval. This is also linked with quantum, ordinary course, and arm's length, and certain related party transactions require majority of minority. Now, all across the Companies Act was always 51% if I own, I am the boss. 76% if I own, I am the super boss. I can virtually do everything under the Act with a 75+% majority. But for related party transaction, a majority of minority concept came in, wherein the minority will only vote in that resolution, and the majority or the related party cannot vote in that resolution. And if the minority approves, only then I can do that transaction. After that, for certain transaction, the law and the regime prescribes independent certification. So disclosures go to those charged with governance, take shareholders' approval, and if after that it is still important, have an independent certification. Like for transfer pricing, we have a transfer pricing audit by a chartered accountant, statutory audit in CARO 2016 and also in the revised 2020. There is a specific clause to say that compliance with section 188 has been done, and also the accounting standard disclosures are appropriately done in relation to related party transaction. Some boards also ask for arm's length certification. And even in the secretarial audit, which is done by company secretaries, there is a clause to certify the compliance with section 188 and the SEBI LODR requirements. Sometimes law has prescribed that if you are doing a related party transaction, I would want to have a cap so that even if you have a shareholder approval, even if it is certified by an independent professional, I just don't want you to abuse that provision. For example, there is a minimum rate of interest to be charged under section 186 under the Companies Act. Or to a promoter manager, you cannot pay remuneration beyond a particular percentage. Or in tax, you have thin capitalization rules wherein you are funding an entity based on more of loan rather than equity, then only a particular amount of interest is allowed linked to your EBITDA earnings. Or SEBI says that if a Maruti Suzuki is paying royalty to Suzuki, which is a parent company, there are caps in terms of how much royalty can be paid to a related party. So there are differing mechanisms and differing compliances that are there in the regime. For some, there is a regulatory pre-approval that is required. For example, managerial remuneration beyond a point. Or in tax, we have advanced pricing arrangements that one can go through. Take a blessing prior so that then you don't have a question on arm's length or the sanctity of that transaction. And last but not the least is some transactions with related parties are just banned. For example, section 185 of the Companies Act doesn't allow loans or guarantees to directors or companies in which directors are interested. Or IBC says that I can't become a resolution applicant if I am a related party and I have defaulted under, or if I'm not eligible under section 29A. Similarly, the Companies Act also has director disqualification. Like if I have not filed my annual returns for last 3 years, then I will be disqualified for being appointing a director in any other company. Section 188 non-compliance is also one of the triggers for director disqualification. So if any of your company where you are a director has done a non-compliance of section 188, you are disqualified as a director for 5 years. And that's the seriousness in terms of section 188 that the regulators are looking at. So different remedies have different compliances, and we'll talk about the key compliances that in terms of the direct tax. And this is very well, most of us are aware that direct tax requires that transactions are at arm's length. We have detailed guidance, the various methods that we have to use for arm's length. We need to maintain TP documentation. We need to take certificate. And last, there is an assessment by a specialized TPO in terms of how related party abuse is sought to be covered through the direct tax or the income tax framework. If you talk about accounting standard, it is just disclosures. And it says that disclose transactions, also disclose outstanding balance. If you have a receivable or payable, we disclose in the annual report those outstanding balances. Disclose nature of relationship, whether it is a subsidiary, whether it is a holding company, whether it is a company in which the KMPs are interested. And for material transaction, also mention the name of those company with whom the transactions have been conducted. SEBI LODR. For listed companies, it requires that listed companies should have a RPT policy, and that policy should also be there on the website of the company. In that policy, you need to mention how will you ascertain arm's length, how will you ascertain ordinary course of business, and what according to you are material transactions. And the materiality policy is also something that should be there for listed companies. A typical feature in SEBI is that, if it is a material transaction, and we saw that there is a majority of minority. So interested shareholders cannot vote in a related party resolution. There was a classic case in Raymond's that happened, wherein the related parties had a conflict amongst themselves. And there was a particular related party resolution where the interested parties wanted to vote against that. I don't want that Mr. Singhania should do ABC. Though they were related parties, they were against of that resolution. So SEBI amended the regulation to say that RPTs cannot vote in favor in a particular shareholder resolution. If you want to vote against being a RPT, you can still vote in that majority of minority rule or that majority of minority process that the company is doing. Companies Act still doesn't allow this, but under SEBI, we now have this carve out that no RPT can vote in favor of a particular resolution. Similarly, there's a royalty threshold of 5%. And if you are doing schemes involving NCLT or any kind of merger, amalgamation, demerger, reduction, then you need to take majority of minority approval if the counterparty is a related party. IBC says that if I am a related party, I am ineligible to become a resolution applicant and bid for that company again. If as a related party, I am a financial creditor to that corporate debtor, I will be ineligible for sitting in the COC or the committee of creditors. And similarly, if I have done some transaction with a related party, then it will be deemed that these are undervalued or fraudulent unless I can justify otherwise. So the onus of proof comes to me in case of IBC. Companies Act, again, gets slightly more nuancical and complicated, where it has given thresholds linked to those 7 transactions that are covered under Companies Act. So if you meet the threshold, which is mentioned over here, then you need to go to the shareholders. If you do not meet this threshold, then you don't have to go to shareholders. So if it is just, for example, sale, purchase of goods, which is A, and the transaction value is 10% or more of your annual turnover or 100 crore, whichever is lower, then you need to take a members resolution. Or it is okay even if you take a board resolution. So it has gone into category-wise detailing of what is a material transaction, and accordingly, there is a repercussion on that a material transaction. Friends, we'll spend 5 minutes on this important flow chart, which kind of will, iron out the discussion that we have had today, and also give some roadmap into how the waterfall of related parties should go. So step 1 is identify relatives. We saw that identifying relatives thing. Then step 2, we go into identify related parties. Step 3, we go into identify if a particular transaction is a related party transaction or not. Now, this is important. Every related party transaction requires audit committee approval. This is as far as the Companies Act is concerned and even under SEBI. So be it a listed company or an unlisted company, audit committee approval for all transactions. We are not talking about just those 7 transactions, but even if it is any other transaction, audit committee approval is must for every related party transaction. After that, if you are a listed company, then you come under the next step. For a listed company, every material transaction goes through majority of minority approval. So if you are a listed company, you don't need to check for arm's length. You don't need to go under ordinary course. Just the fact that it is a material transaction, you go over here and you take majority of minority resolution and do the transaction. If it is not material, generally every company has its own materiality policy, but that materiality policy cannot be more than 10% of the consolidated turnover. There is a proposal in this Srinivasan committee to increase that 10% to 5%, but as it stands today, it is 10% of your consolidated turnover. If it is not material, then you check whether it is under those 7 transactions which are covered under section 188 or not. If it is not one of them, go ahead and do it, no problem. But if it is one of those 7 transactions, you need to check 2 further tests, whether it is in the ordinary course of business and whether it is at arm's length or not. If it is in the ordinary course of business and under arm's length, go ahead and do the transaction. No need to go even to the board of directors. But if it is not at arm's length, or if it is not in the ordinary course, you would need to go to the board of directors. In the board of directors, you need to check the threshold. In the previous slides, we saw the thresholds. And if it is more than the threshold, then you need to go and take a members resolution. If the paid up capital of your company is more than 10 crores, then anyways you need to take that members resolution. But if not, go ahead and do the transaction. So it's a slightly nuancical and a little bit complicated at first sight in terms of the process, but something that can very easily flip through from a Companies Act is if it is a transaction that is in the ordinary course and at arm's length, you can clearly do it without any shareholders resolution if you are an unlisted company. And ordinary course and arm's length is something that the audit committee and board will decide. So this is a broad overview of this particular waterfall. Slightly difficult in a virtual setting to have questions, but the objective and idea over here is to make sure that we have something which we can put through a transaction and we'll get a result, what I need to do as a compliance. Now, these are all of the related party requirements, but as a CA or as a statutory auditor, what are my key obligations? Because a bulk of what we saw till now would be an obligation on the company to make sure that they do all of these compliances, to make sure that they kind of take the resolutions that are required. But as an auditor, where does my obligation come in? So apart from the general compliance with accounting standards, true and fair, that we give in our audit reports, CARO also requires under the specific clause to say that whether all transactions with RP are in compliance with section 177 and 188. 177 is the audit committee requirement, and 188 is the requirement where those 7 transactions are listed. And also, the second obligation is whether details have been disclosed in the financial statements as required under applicable accounting standards. So maybe in your main audit report, you have a carve out of true and fair. You have a carve out to say that there is no material misstatement. But over here, you have a very specific obligation that whether details have been disclosed in the financial statements under the applicable accounting standards. Here you don't have the true and fair. So effectively what you are committing over here is correctness and just not fairness or material misstatement not being there. There is SA 550, which deals with related parties. And if you look at the CARO guidance note of the ICAI, it requires that an auditor should do 5 things when it is commenting on the CARO clause which is listed above. First is obtain a list of entities that are covered under related party transaction. And I don't know if most of us do that or not as a part of our audit procedures, but guidance note is something that is applicable and binding to us, and we should do that. Recently, we were assisting a particular CF firm in the practice review that they got from NFRA. So NFRA conducts reviews on some of these audit firms who are auditing large companies, and there were certain questions, and we identified that this particular list of entity, which is maybe a slightly basic thing, was not there in the audit file. So it's important that all of us in the clients that we are auditing have a list of entities that are covered under related party. And it cannot be a consistent list because relationships evolve, transactions evolve, and this has to be on a particular date that you need to look at. Similarly, how has this list been compiled by the entity is something that you are supposed to review, that whether the procedure followed by the entity is something that has proper checks and balances or not, and check your previous year's working papers to see whether every party that was covered under the last year continues to be here and there are no exclusions, or if there are exclusions, there is a rationale and that relationship has ceased because of which there is an exclusion. How do you test whether a transaction is arm's length or not? Mind you, CARO requires us to see whether the transactions are in compliance with Section 188 of the Companies Act or not. Now, there can be 2 ways to evaluate this obligation that we have on auditors. Do auditors need to actually test arm's length and actually test whether they are in ordinary course or not? Or do auditors just have to see whether the board has made a view on its ordinary course or arm's length? The guidance note seems to suggest that the auditor may also test, it's not shall, whether the transaction is at arm's length on transfer pricing mechanism. So we have the TP methods available, which CAs are conversant with, and apply TP methods to see whether the transaction is at arm's length or not. Acknowledging difficulty in identifying ordinary course of business. So the guidance note says that it's very difficult for a CA to conclude whether a particular transaction is in the ordinary course of business or not. Recently, we had a case of a very large airline, and the question was that whether the transaction is in the ordinary course or not. The airline, being a listed company, the promoters of that listed company had opened a pilot training center or a flight stimulation center, and the pilots of the listed company were actually being trained in that promoter entity which had the flight stimulation center. Now, whether that transaction is in the ordinary course or not is very difficult to ascertain. From a listed company perspective, the minority shareholders would feel that this is such an integral function of a pilot training, and why should a promoter entity be engaged in that? It should be done by the listed company itself. But when you see from the promoter's perspective, their rationale was that, look, this is a different business. It's not same as flying a plane. You require software, you require trainers, and it's a service business. And there is no such service provider available in India. And I want my pilots to be best in class. So I have gone ahead and invested in that. Now, whether it is at ordinary course or not is something that is very difficult in some of these situations. And the guidance note suggests that yes, it is difficult, but then it goes ahead and provides certain exclusion list that if it is some of these things, then clearly they are not in the ordinary course of business. For all others, exercise your judgment and evaluate whether they are in the ordinary course of business or not. Generally, we see board of directors obtaining certificates from chartered accountants, whether this is in the ordinary course or not, or arm's length or not. I would suggest that you take guidance from the board as to what should constitute an ordinary course of business. We have seen boards give direction to the CA that These are the 5 parameters. And within the 5 parameters, you test whether these are met or not. For example, whether it is covered under my main objects of the memorandum or not, whether similar transactions have happened in the last 3 years or not, whether it is less than a particular materiality threshold. If those 4 or 5 conditions are fulfilled, then you can conclude it is not in the ordinary course of business or in the ordinary course of business. So that guidance is important because ultimately the buck stops at the board to form a view whether it is in the ordinary course of business or not. And the last thing that is required from the auditors is to obtain a written representation in terms of which all related parties are covered. And if at all there is a material related party transaction, take a specific written representation that this is at arm's length and in the ordinary course of business. There's one issue that we see being faced by many auditors is that when a consolidated financial statement is prepared, where you have 3 subsidiaries and you prepare a consolidated financial statement, you audit a consolidated financial statements. Typically, what we have seen is that the accountant would pick up the notes to accounts, which has the related party disclosure in the subsidiary's financial statement, and will add it to make it the parent company's disclosure. Now that can leave out a lot of things when you are consolidating just basis of the notes to accounts, because you as a parent company need to identify what are the related party relationships. The subsidiary will have a different set of related parties and a different set of disclosures. For example, you have a director on your board as a parent company, and the subsidiary wouldn't have that director. Now, in the subsidiary's notes to accounts, if it is a transaction with the parent company's director, it may not have been disclosed. But as a parent, you are supposed to disclose transactions on a consolidated basis. So the best way to go about is that have your list of related parties, send it to each of the subsidiaries and tell them to confirm that what transactions are there in each of these subsidiaries vis-a-vis the companies or the relationships that have been identified by the parent company. We also see in the group reporting instructions that the holding company auditor would send to the subsidiary company a list of related parties being attached so that every subsidiary can give a confirmation that with these entities or with these relations, there are no transactions. Friends, before we can take up questions, there are certain issues which I've tried to list down, which are contentious. I don't know if there is a yes or no answer, but one of the issues that comes to mind is that does a related party transaction work in a reciprocal manner? So if from perspective of company A, if company B is a related party, then does the other way also work? Would company B also by default show company A as a related party? To my mind, as it is drafted right now, the answer is no. A company will need to see from his own perspective whether it is a related party or not. For example, daughter's husband is a relative, but from that daughter's husband's perspective, father-in-law may not be a relative. So that reciprocity is not there. Just because company A has disclosed you doesn't mean that you become a related party for company A as well. There is a question whether transactions entered into wholly owned subsidiary of a listed company require compliances at a listed company level. Now, this is talked about a lot, that if a listed company is doing a related party transaction, you need to go and take shareholder permission, arm's length, ordinary course, all of those provisions are there. But if the same transaction is done by a wholly owned subsidiary, there is no such compliance that needs to be done by a listed company. And this is something that is open to abuse, and which is where the January 2020 committee recommends that even if it is a wholly owned subsidiary that is doing transactions, you still need to take majority of minority and other consents at a listed company level. There is a transaction where, let's say 5 years before, a long-term lease was entered between 2 related parties. And 5 years before, when that lease was entered, a one-time upfront payment was given. Now, as we speak today, there is no outstanding, there are no lease payments that are happening, and there is no disclosures that comes in. So it may happen that I am a investor or I am a shareholder, and the company may be having a long-term lease arrangement with a promoter company, and I may just not be aware of that particular transaction because neither it comes in disclosure nor it comes in shareholders, because it may have been done in the past with I not having any visibility. Similarly, if there are transactions between subsidiary companies with its related party, they don't come into the parent company. So if a subsidiary has paid certain amounts to its related party, if that related party is not a parent company's related party, then that disclosures will not come. I will remove it from when I see my consolidated financial statements. So this can amount to some leakages in terms of how these transactions may not get reported or may not go through the approval route. A typical question comes is that if a contract is once approved and then it is proposed to be modified, will it require fresh consent and compliances? So I may enter into a long-term license arrangement with a particular royalty, and subsequently, if I want to change the terms, would it mean that a fresh consent would be required? As it stands today, it is slightly unclear that a subsequent modification may also require a fresh consent. But again, the committee of SEBI recommends a specific amendment to the definition where even subsequent amendments to the transaction would need to go through the same process. But as it stands today, if it is a modification, then it's not clear in terms of how it would work. A typical issue comes if it is a non-monetary transaction. Let's take an example. I am a listed company and I have given right of first refusal on sale of any assets to a group company. Is it a related party transaction? Is the question. Our memories are short, but some years before, when Arcom or Reliance Communication was entering into a transaction with MTN as a part of a merger or consolidation, it came to light that there is a right of first refusal that Arcom would have given to the elder brother's company. And that transaction couldn't go through, maybe because of one of the reasons was the ROFR to a group company. Now, those ROFRs or some of those related party transactions may be so important, but being non-monetary or being not covered in some of the framework, there are gaps in terms of how one can look at some of these transactions. So, yeah, I think we have reached our time for this technical session. But what I wanted to drive home as a point is that there is a balance that is ongoing between commerce and conflict in terms of this related party regime. And more we are seeing that because of the abuse of RPT that has happened, there is a tightening of screws by the regulator around some of these related party provisions. And it may only enhance going forward, looking at the way things are going. Mehul, I think we can take some questions now, so that make it more interactive rather than a monologue for everyone.
Yeah, definitely. I request members, if anyone has the questions, then they can raise their hands. Yes, Shailesh bhai. Please unmute your Shailesh bhai. I think, Anandji, we can address the questions already which are there on the Q&A tab first.
Okay. The question is write-off of receivables from subsidiary against provision made in the earlier years, whether it will fall under RPT, under Ind AS, Companies Act, and LODR. So if we are writing off receivables from a particular subsidiary against the provision made in the earlier year, so it was already provided for, and then we are writing it off. I would think that there is per se no transfer of resources that is happening, and nor in a sense there is any change, because you have already provided, and when you would have provided, you would have disclosed it as a related party transaction. So if you're talking between provision and write-off, whether there would be any kind of requirement, I would tend to go on from a strict interpretation of the language that there may not be required. But Nikhil, again, from this RPT perspective, it is more of substance over form, and it's always good to err on the side of conservatism and disclose it when in doubt.
Yeah, Anand.
Yes, hi Nikhil.
Am I audible?
Very much.
Yeah. I think LODR or maybe listing agreement requires such disclosures when you actually write off. So I need to again recheck, but maybe 3-4 years back while we faced such situation, my opinion was that when you make a provision, there is no transfer of resources. It's just a provision. But when actually you write off, I think LODR requires that you should disclose. Particularly in RPT, even if it is write-off, because this is balance sheet to balance sheet impact, no impact on P&L.
Yeah, I think I would tend to agree with you. If you have not taken a resolution when you had done the provision, then clearly there is merit that the shareholder should be aware that this write-off is happening. But under the assumption that when there was a provision, there would have been disclosures enough to justify, I think one may take a slightly different view. But yes, I think we'll have to take it on the situation.
My personal view is when, like in this particular case, we did disclose when we made a provision. But at that time, while going through the listing agreement in detail, my opinion is that against those provisions, even if you write off, because it is not going to affect your balance sheet or P&L. I mean, balance sheet, yes, no cost. And in any case, you are disclosing the net. But yet, because of LODR, this disclosure is required. I mean, that's why just I wanted to draw the attention of the member. So I did this point.
Perfect. Very helpful, Nikhil bhai.
Thank you. Thank you.
Ketan bhai, you can ask your question. Ketan bhai. I'll just read out the question of Ketan bhai. Whether reimbursement of actual expenses, sharing of expenses among group companies require RPT approval?
Yeah, I think yes. Even if it is reimbursement, it amounts to that transfer of resources, and companies have been taking even reimbursement of expenses as a part of their related party disclosures. There is a flexibility that you can take omnibus approval, where you have some of these transactions which are not so large and very much recurring in nature. You can take once in a year omnibus approval for some of these transactions. But yes, reimbursement will also amount to a transfer of resources.
One more point here, Anand. We have come across, I mean, some of my friends are calling me and asking in a small firm what happens. Like even if, I mean, it could be a case of LLB partnership or even a private limited. Now that you have to pay your profession tax or income tax compulsorily through your net banking. And sometimes, I mean, I have such instances during lockdown also that I have to make a payment and I will pay it from the net banking of directors and then company issues checks. So I advise them that technically it is a reimbursement, disclosure will come, reimbursement kind of a thing. What's your view on this?
I agree with you, Nikhil bhai, that reimbursement will also be covered and it's better to disclose that.
Sailesh bhai, can you ask your question? Sailesh bhai Kamdar, can you unmute yourself?
Yeah, thank you. But my question got answered in one of the reimbursement matters.
Okay. Right.
Thank you.
Another question by Narayan bhai. Can you throw light on the Rahul Bhatia and Rakesh Gangwal loggerheads over unequal powers to one party, especially RPT between Indigo and Interglobe Enterprises?
Yeah, I think it may, Narayan bhai, you're putting me in a spot, and it may not be good to speak on any particular company. But yes, I think it goes to the heart of the problem where you have transactions between two promoters, that is inter-se between promoters, or between a promoter entity with the listed entity, and then those transactions are alleged not to be passed through the audit committee and the board, and the other shareholder has a grievance that there was not much visibility on some of these transactions. So it's still your word against my word. But yes, there are issues there in terms of Indigo that also prompted this particular committee to look into and suggest changes that may be required to the existing framework. On a lighter side, Narayan Bhai, since you have raised this point, I think one anecdote that comes to mind is that there was a particular locomotive or a train that was going on tracks, and the train had various passengers, about 300 people, sitting in the train and traveling, let's say, from Bombay to Delhi. In the night, the trainman saw that there are 2 or 3 people who came on the track from the villages, and the train actually went off the tracks into the farms, and a lot of people got hurt from the people who were sitting in the train, those 300 guys. So when inquiry happened and the train driver was called, that look, you have been told since day one that don't risk the life of those 300 passengers for 2 people who have come on the track, and drive over those 2 people, because you don't care about 2 people in saving 300 people's life. So the train driver said, I have done that only. I wanted to run over those 2 people, but those 2 people went into the farm. So I had to take the train to the farm. So something similar is happening in the related party regime, where because of these 2 or 3 instances, the law keeps changing. And you are building in now more and more protection in the law to avoid these sort of black swans, because of which the people or the majority who are compliant will also have to go through these compliances and make sure that they fall on the right side.
Girish Bhai, you can ask your question.
Anand Bhai, there was a question that when reimbursement is given in respect of a related party tax payment, then we should be reporting that. But my question is, if the related party gives the company the money in advance and then asks the company to pay the tax or whatever the payment is to be made more as a facility, then will it be a transaction to be reported? It's just a service which is being, because the RP doesn't have that arrangement. Money is already come to the company in advance.
Yeah, Girish Bhai, the wording of transfer of resources, if one seems to suggest, then essentially, cash coming in, yes, it is not attributable to me or it is not accruing to me. But in a sense, there is still a transfer of resources.
But it's a reverse transfer. The RP has given the money to the company to be just paid out through an arrangement which the company has.
Yeah, unfortunately, even if it is a transaction that is a preferential or a better thing for that particular entity, it still requires to be disclosed. It's not that transaction where I'm shortchanged. In transactions that are potentially beneficial to me or where I have no risk, those also require a disclosure. So my view would be that the fact that there is cash coming in with a related party, it's better to disclose in that sense.
Okay, fine, thanks.
I think I would answer this in a different way, that initially when other person is transferring the resources, and as I think Girish Bhai rightly said, that the services, in any case, service is rendered. I mean, first you pay me and then I pay to somebody on your behalf, is again nothing but the rendering of services. So it will squarely fall under RPT.
Right.
Girish Bhai, that I think answers your query.
No, my view was that the resource is already been given by the director or the RP to the company.
Agreed,
so
sir.
It is a liability lying with the company.
Agreed, sir.
So
but
then whether there is a transfer of resource at all.
Absolutely.
The resource is already provided by the RP to the company. It has just been utilized. So per se, there is no transfer of resource of the company to anybody.
No, I mean, in the first instance, when the company is receiving money, it's kind of advance against expenses to be incurred.
No. It is like that RP wants to pay his individual PT or individual's any tax liability. He does not have an operational arrangement for any online payment. The company has it. So director says कि ये मेरा पैसा आप लिख लो, मेरे behalf पे pay कर दो.
Correct.
So whether that is a transfer of resource from the company or even from the RP is a question. That was my question.
Girish Bhai, exactly the same issue I was raising, I mean, discussing with Anand. I have, during the lockdown, some of my friends called me for this.
No, that is why I raised that question, because your question was that you paid, the company paid on behalf of the RP, then the RP reimbursed it. But for some instant of seconds or minutes, the money was duly transferred or the resources were actually given to the RP. But what I was thinking is if the resource is already pre-taken from the RP, whether then one can say the resource has been used.
No, correct. But let us say no reporting is required if the entity himself is a bank. Now, it not being a bank, I receive money from you and then I make a payment of, let's say, income tax or profession tax or sale
Yeah,
tax. Because during
true.
lockdown, somehow practically it has happened.
It has happened. Yes, it
Like
has
in my
happened.
case, I went to the bank that I want net facility. They says no, unless the lockdown gets lifted, we cannot give you the net banking facility. Now, similar many people would have faced, and meanwhile they had the fund, due dates have come, so they have made a payment through this. But then people were asking me, Nikhil bhai, in this case whether RPT is required. I said yes, strictly it is yes. I mean,
Nikhil bhai, we can have some more questions.
sure.
Let's
This is
proceed.
just to,
Yeah.
I mean, clear the doubts of Girish bhai.
Sure. Vijay bhai.
Vijay bhai?
No, I was also trying to put the same point of related party transaction when taxes are to be paid by the
Fine.
directors or
Fine,
vice versa. So I was just unmuting myself quite on and off.
Okay. Sonal Jain, can we have your question?
But one thing strikes me, Anand, if we have to go for the substance of the transactions, if in substance it is only a reimbursement of tax payments or some ROC fees paid for on account of the company by directors, it should not get reported in the related party transactions, because otherwise also they get reflected as an expense of the company as ROC filing fees or the advance X payments. I am having that view that we have to also look at the substance.
Yeah.
What is your view?
Yeah. So I think if we see, let's say the Companies Act approval mechanism, it lists down those 7 things, and then if there is no reimbursement there, then clearly we don't know. But when it is coming to disclosures, they are saying that disclose everything that is there, irrespective of applying the judgment that whether a particular thing amounts to reimbursement or it is let's say in the nature of loan, because then someone can stretch that particular thing to say that I had given maybe a bit of a liquidity in that sense, but it is a reimbursement for me. So that element points out that it's better to disclose as far as disclosure is concerned. Yes, if that transaction is not falling within materiality or within those 7 parameters, then no need to take any audit committee or board approval. But disclosure is something that is there for all transactions.
Anand, there was one question in the chat. An individual holding 45% of the shares of a private company, he is not a director of the company and he has purchased transactions with the same private company. Whether transactions with this private company are required to be reported under Section 40A(2)(b) of the Income Tax Act?
Yeah, I think 40A(2)(b) will have to be looked at slightly differently, and there may be tax experts who can help me here. But as far as from the perspective of related party transactions is concerned, the fact that there is a 45% ownership in that private limited company, one may want to believe that there is significant influence that that individual has over that private limited company. And because of significant influence, it would be something that will be required under AS 18 and under Ind AS 24. I think as far as 40A(2)(b) is concerned, I'll reserve my comments in absence of adequate insights on 40A(2)(b).
Fine. Any more
Any other
questions?
queries which the members wishes to ask?
There was just a question which last was raised by Janam, that in case of that 45% shareholder, he is purchasing from the company, Janam?
Yes, sir. He is purchasing from the company.
So for the company, it's a sale.
Yes.
And 40A(2)(b) does not apply to the income side. It applies only to the expenditure side. So it should not get reported under 40A(2)(b). 40A(2)(b) per se lists out the expenses which is in respect of the related party transactions.
I think Girish bhai, the question, if I'm reading in the chat box, is saying that he has purchased transaction with the same private company.
If the purchaser is the individual shareholder, for the company it's a income transaction.
Yes.
Which is not the category of reporting. 48(2)(b) is on the expenditure side only and not on the revenue side.
Yes, yes, Girish.
So that should conclude if it is that way. If it is revenue for the company, 48(2)(b) is not applicable.
Yes.
And that too, one addition to that, that if it is debited to profit or loss account, then only it is to be reported. If it is a capital expenditure, it need not be.
Lot of carve-outs.
Yeah.
Okay, members. With this discussion, I'd just like to make few announcements and then the pleasant task of vote of thanks to Anand Bhai. Members will be having our next virtual meeting on 18th of July by CA Hinel Patel on Auditors Report, Recent Changes and COVID-19 Reporting Obligations. It will be on 18th July, Saturday, same time 5 to 7. Anand Bhai, you have very lucidly, explained us what are the related party transactions, who are the relatives, what are the transactions, and how the transactions are to be reported by the entities. It was in a very proper manner, and the chart that you have displayed for the companies, it will be very helpful for all the members. I, on behalf of Vile Palace Study Circle, request all the members to give you a round applause. That won't be possible on this virtual thing. And as you told that we are missing this meeting, the snacks that we have at our NM college.
Yeah.
So of course, all the members are missing that. And we hope that we'll, join some months back on the platform and have all those snacks. Thank you, Anand Bhai. Thank you, all the members. Do join us for the next meeting. Thank you.
Thank you, Jana. Thank you very much.
Thanks a lot, Anand Bhai. Thanks a lot.